Welcome to this Killick Explains video. And in the current market, which is a little bit trickier, I'm talking about the stock market than it has been for a while, I want to talk about this time how higher interest rates can potentially hurt equities. Now, everybody knows that interest rates have been on the rise recently. As I make this video, there was finally a pause at 5.25%. That is October 2023 last month. But prior to that, the Bank of England, responsible for setting interest rates, had raised rates 14 times in a row. That is one of the most aggressive patterns of interest rate rises since the 1980s. Now, clearly, that's going to have an impact on companies and markets. And the specific impact I want to look at the moment is a severe reduction in companies buying other companies, what the city likes to call M&A, mergers and acquisitions. The volume of deals, visible ones on exchange, that's where listed companies buy each other, is well down, aggressively down, and harder to get information about, but nonetheless true, nobody escapes. In the private credit or private equity world, it has become increasingly difficult to trade a company, to sell up, as a PE house would have it. Now the question becomes, what's going on, and should investors worry? So first of all, let's think about why are deals in normal times when interest rates were much lower and there was more certainty around, why are deals popular? Why does one set of directors decide to buy another set of directors? And the answers come in sort of two or three shades, if you like. Number one, buying somebody else, growing a company, making it bigger is frankly easier than doing it the hard way. The hard way is called organic growth, and that is developing a company from the bottom up, if you like. If you can go out and grab some market share, grab some innovation, grab some good people by buying another company, it's quicker and it's easier. Growth and prestige tend to go together. So ambitious company directors think they make their mark in the city and on investors, which is to a degree true, by being bigger, by being aggressive, by showing that they're up for takeovers and winning deals. But you have got to pay for them. So what about the funding? Now here's a catch-22, and this is what's changed in the current market. So the catch-22 is this: if interest rates rise, all other things being equal, targets get cheaper. Now you see this in the housing market, if that helps. Property prices are, as I make this video, falling because the cost of paying for a property has risen. And that's true when you go out and buy a whole company. But you've still got to pay for it. And there are only really two ways, essentially, that a predator can pay for a target company. One is to borrow the money, it needs to pay for it, a bit like you might take out a mortgage to buy a house. And the other one is to use its own funds. But those funds are not free. Every pound sitting in your pocket right now, sitting in a predator's pocket, is a pound that needs to be earning its keep, or it's not free money. So a predator's cost of capital rises, as it's called, the cost of doing deals, funding them rises, regardless of how it chooses to pay for them or structure the deal. All right, and that's quite important. So basically, why do targets get cheaper? Well, in essence, it's a function of what's called discounted cash flow. Okay, so if you're pricing something you're going to buy, you basically map out the future cash flows, reduce them to similar today's terms money. It's called a present value using a discount rate. And essentially, the higher the discount rate, the more aggressively you reduce those future cash flows and the less the target is valued at. All right, and interest rates affect that discount rate. All right, so that is why targets, all other things being equal, become cheaper when interest rates rise. But don't forget the flip side of the coin. Why is funding more expensive? There's less credit available to predators. The hurdle rate of return that they need to earn on their capital rises, because if you think about it, if you can get, let's say, 5.5% by putting £1 in the bank, whereas 6 months or a year ago you could only get 2%, then if you're going to buy a company using that pound, that company needs to generate you more money to compensate for the fact you could just put your money in a bank account and go home. All right? So predators may actually run out of ways of funding targets even when those targets are cheaper. Think of it this way. Why are first-time buyers not jumping on cheaper properties right now? I mean, they're cheaper, all right? I'm coming back to this in a future video. It's because they can't get the funding, or the funding's too expensive. Mortgage rates have risen. Well, that is very similar to the dilemma facing predatory companies out there in the outside world. And it also affects companies that want to do initial public offering. Let's come back to that now. So why does a jump in the cost of funding matter? Number one, in public markets, initial public offerings where companies are brought to the market, unveiled, if you like, are key. Okay, and at the moment, there's no appetite for that. There are no investors going, oh, I want to buy an exciting new company because I'm worried enough, if you want to say it this way, about what I've got in my portfolio already. Then you've got the private equity markets. These are the hidden markets, behind the curtain, if you like, not public markets. They're vast. Companies are bought and sold there, and you don't even get to hear about them a lot of the time. Huge companies. Now, we can't tell what's going on there as easy as we can in public markets, because the FT doesn't report on it every day in the same way, let's say, or Bloomberg. But rest assured, if public markets are weak, the number of deals being done behind the scenes is also dropping like a stone. And of course, all of this affects confidence. And that's the problem. People like to see deals getting done because they think, well, that's an active market, other people getting involved. When those volumes drop, things get a little more hairy. So, as an investor, what are you supposed to do with this? My 5 takeaways. All right. Number one, be wary of firms that have been highly acquisitive in the recent past, because they may well have overpaid. It's as simple as that. I'm afraid it's a function of the way market cycles work. How can you tell? Well, here's a bit of technical jargon. If you ever see evidence in the media of something called a goodwill write-down, ooh, what's that, Tim? That is essentially companies taking a charge against profits for the fact they've overpaid. They literally have to look at the assets they bought 2 years ago and think, ooh, crikey, if I had to sell those now, what would they be worth? A bit like buying a house and saying, oh, crikey, if I had to sell it now, maybe I don't have to sell it now, but if I did, I wouldn't get as much as I did 2 years ago. I better recognise that difference or let my shareholders know about it. Look for experienced management teams. This is no market for new CEOs, people with no experience in the sector or industry. Avoid any investment you don't understand. Avoid acquisitive companies where the logic for a recent deal just doesn't stack up. It's not good enough to just say, we want to be bigger. Why? Strategically, how does that work? And keep a long-term view. IPOs will come back. The private equity market will recover. But in the meantime, just be ready to ride out a rougher patch. Now, I've done videos on a lot of the jargon I just mentioned, and there was quite a bit of jargon in there. So that's killick.com/learn, and maybe go for the shares tab. You can also read all about how to invest in equities in the guide sitting next to me, editor@killick.com. And for a copy of Confidant, where you'll find our special situations team, for example, will write about possible bid targets using the language I've been using in this video. Again, editor@killick.com.